Everyone, welcome to the Income Masters channel. It is September 24th, 12:30 p.m. Eastern. You're with Dave Durham. My name is Emily Norris with Traders Reserve. Today is a deep dive into tactics. We are recording this session and we will be posting a replay to the platform. If you have any questions, you can pop those in the chat box. With that, I'll let you take it away, Dave.
All right. Thank you, Emily. Welcome back, everybody. This is a deeper dive session here on Wednesday. So we will get right into it. We're going to look at defensive adjustment metrics. I know we talked about doing a case study of part two on case studies for trade recoveries. So this included a little bit of that, but I think it'll help lead you into what I think we've been doing when we do defend trades and make adjustments on those. So that's part of our Wednesday today, about 15 to 20 minutes of this, and then we'll take questions, and then we'll be back for live trading and review tomorrow. We'll take a look at the market before we leave, but no real new trades or management of positions today. What we're going to do is review of managing, just the idea of managing defensive adjustments. I'll do this that part rather efficiently here, so we don't need to go back over it. It is pieces of information that we've gone over before and we talk about all the time. We'll do a reminder of the Costco trade recovery case study, just one slide on that to remind everybody how we managed through that position. And then we'll look at an overview of our Income Masters trade metrics. We usually do this at the halfway point in the year, but just to compare it when we're defending trade metrics too. Those are the slides I think that'll be most interesting to go through and look at what we've been accomplishing when we do manage trades versus what we do when we have a profitable trade we close with a target exit. So, we all know this, why defense matters. While credit spread is a defined risk trade, it can lose money and losses can grow quickly. So defending early helps reduce losses or extend profitability. So our goal is usually to buy time, reduce risk, and reposition recovery. And on top of that, really try to collect more credit to our trade and add more credit to our trade. Again, I think all of you are familiar with these options to adjust. We can roll the position out, the days to expiration out, and the strikes with them. We can roll down or up if we are in a put spread, down if we are in a call spread, to adjust the position as well. We can convert the spread into an iron condor or butterfly to help offset the risk, and we've done that a number of times as well. A total trade reset, where the move against us is so big that we just reset the trade. We basically close it and reopen it as a new trade. Not trying to manage the existing strikes, particularly if a big move or gap down or up. And again, this all depends if that original trade thesis that we got into this trade holds up. If something really has gone wrong with the company, we will back out. And then we could cut losses early. We haven't done really too much of that. We did a little bit of that last year. We haven't taken really short losses. Not because we're trading so well so much as we have been managing most of these trades. And again, we'll go through that as well. I gave these guidelines out before. When stocks are in that 5 to 10% out of the money, they're generally okay at that 18 to 22 range, but we'll watch them closely. If they're in the 11 to 20% out of the money range, then in pretty good shape. Should get the theta decay, hit our target. Anything really over 20%, we should be hitting our target exit soon. So I do keep an eye on those every day. And there are exceptions to these guidelines. We may go less than 5% when we're in a short-term adjustment because we've been rolling a recovery trade and want to continue to adjust that trade. And of course, the biggest thing that I am big on, or that I think is most important, is trying, if you can, collect more credit. More credit gives you more room to defend your trade. So when you combine that with duration, it gives you even more room to manage. And on higher price tickers, I prefer if we can roll these spreads out for $1 or more. That isn't always the case, but if we can, we'll take it. Paying a debit to defend a trade may not limit your options, but it can limit your room to defend. So that's why we tend to prefer credits if we can. Obviously, debit increases as you try to lower your strike. So if you try to go way out of the money with an adjustment, you're going to have to pay for that. So what are you willing to pay for a 5 point reduction in the strike price? 20 cents, 50 cents, and 75 cents or more. And can you offset that with a credit on if you're adding a call spread, let's say, for example, on a put spread trade? So these are all actions and defenses we've done, and we have made them work. And so I'll go back through those numbers again when we get to this. You'll get to see how this has been playing out for us. We did have a Costco trade recoveries case study we did back in July. This was a trade that we were in, and you can see here the numbers and the metrics on this trade. We did 8 adjustments. We were in the trade 118 days. That's a little more than 3 months, obviously, almost 4 months. And we credit at close was $1.30. So we actually picked up $390 of profit. Actually, not a bad profit. It was overall a 7.5% return, so we can't really complain about that. But the return per day, and we'll talk a little bit more about that, was only a 0.1%. So it was very little. Our goal is 0.5% or more, and we are generally hitting that. The net average adjustment, we got about 20 cents per credit. Our average net debit, $5. And our deepest hole, this is the thing that I've gotten asked about before. On the Costco was $9.50 debit on 3 contracts, or about $28.50 on paper. So if we had closed it at the deepest part of the defense, we would have taken a $2,850 loss. So that only reached it on paper. It was never a loss we took because, again, we made the adjustments. We worked that down. Costco sort of settled down also at the end and allowed us to move on from that. And that can or cannot be what happens with trades. We're well aware of the trades that we still have open from the time when Costco got hit. A lot of that was the tariff shock and the policy uncertainty that came in April. And so we're still April, March, and we're still defending, 4 trades and 5, actually really 5, but 4 that we're close to that are deep in the hole there that because of that one period. Ever since then, it's kind of changed. So now let me put a little bit of some perspective. This isn't a numerical chart that I usually update and we go over at the end of the year, and actually went over a little bit, I think, in 6 months review. But basically our trading metrics, and we're going to compare them then to trades that we have had to defend. So you can see the comparison on this. And I broke this into 2 categories. I've been tracking trades since July 1st separately, although they're all combined together when we look at all 2025 trades. But this is new trades since July 1st. This is all new trades opened up in 2025. So we opened up 43 since July 1st. We've closed 33 for profits. We haven't taken one as a loss yet. Our average, the applied volatility rank is 24.71. So it has come down as volatility has basically contracted in the summer, late spring and summer. Our open, we were at 28 days, has been our average open. And you can see actually compared to all trades, that's consistent. I guess I should use the comparison here. Our IVRs come down a bit because, again, if you remember, March and April, we had IVRs in 2030 and up as high as the VIX reached a 50 level. So it was bound that we were going to have some trades that had higher IVRs. We also opened 105 new trades this year and have closed 90 for profits as well. When we open a trade, our average delta since July 1st has been about 0.20 or minus 0.20 if it's on a sold put, but we've also had some calls. Sold calls, we have 0.19 in all 2025 trades, so slightly lower. Actual days in trade, DIT is what I call it, days in trade, 13.65. So we're open, the average open, is 28. So we cut that down less than half the days we're actually in the trade. We were in trades a lot, at least on the big numerical addition. By the way, this does include madness trades, so that's why this comes down a bit, because we ended up with shorter DTEs and shorter trade closes on income madness on those. The average move of the underlying has been 0.7%, meaning the stock that we traded or the ETF we traded only was up less than 1%. And that actually shows again why these are neutral to slightly bullish or slightly bearish trades. We don't need the stock to be up as much as it is. We had stocks average all year long at 1.9, and again, a lot of that was a combination a very good January, and also a very strong April, May, when the market bounced back after the tariff shock. So definitely have a change there in the move of the underlying. It helps when stocks are moving in our favor. The average percentage of max profit, we go for roughly 55% of max profit. So our average through the first part of the year or all the year has been 61%, but we've been a little tighter in the last 60 days in effect, and down around 53%. So and we'll continue to be at that range here as well. This is the profit in the live account that I'm tracking for since July 1st, $7,472 and $18,000 for the year, 630. Again, that doesn't include the trades that are still open, and it doesn't include, obviously, the trades we're still defending. The return on capital has been a little higher in the last 2 months, 11.7% return versus the year-long average of 9.8% return. And here's the interesting number, the daily return on capital. This is basically the return divided by the number of days in the trade, has been less than 1%, and it's throughout the year, it's been about 1.3. Our goal is to be 0.5% or more, 0.5% or more. If we can collect that every day, we're still going to be in good shape, better shape if we can get 0.9 to 1.3. But again, and you'll see as we get into the next couple slides how that compares to basically we defend a trade. Now, these won't be as nice and clean. I apologize, I didn't have a chance to get these ready, but let's go through these defense trade metrics. So since July 1st, we had those 33 closed profitable trades. We had to defend 4 of those trades. 3, we had one roll, one with 3 rolls. So we had three trades where we only had to roll it once. We had 1 trade where we had to make 3 adjustments. So our average rolls of 1.5, and days in trades were 34.25. So we're still, we're extending the days in the trade by adjusting and defending our trades. Year long, and again, all these trades, typically all trades in 2025 do not count Vertiv yet. We're about ready to roll out of Vertiv, CRM, CEG, Lulu, and Meta. We're about ready to roll out of Meta too into a profit. So we closed the 57 profitable trades, 11 successful defenses, 1 with 5 rolls, 1 with 4 rolls, and the average rolls were 2.6. I think somebody asked me about this when we did the last recovery case study. We did have a longer days in the trade of about 50. If you take all the trades, because we had a couple trades that were out. One trade was out there 83 days, and another, I think, close to 90. So that was in fact, that we just looked at, that was 110 on the Costco trade. So we do have that longer trade. So again, I'm not including these. When we get those all locked down and finally settled, we'll include these in the counts as well. We had the 4 profitable defenses, so that was $1,170, which made the defending of those trades worth it. That was a 15.25% return in those 34 days we talked about. The average daily return was 0.53, so we'll take that for those defended trades. And on the average daily return on non-defended trades, 1.5%, as we talked about. Through the year, 11 profitable defense trades for $2,800 and 16, actually a pretty decent percentage, 16.96% in 50.65 days, and a daily return of about 43%. So 0.43%, excuse me, not 43%. So average daily return on all trades, including non are all non-defended all defended trade or non-defended trade. Excuse me, it's 1.9%. So you can see what happens here is when we go back here, we look at this. Our daily return on capital is a very robust 0.5% or more. It's 9.9% in the last 60 days, 1.3. And obviously, when we get into adjusting positions and rolling them, we're in those positions longer. You all know that because you're in these trades too. So we're taking a little less capital if we really extend those out. Even though in some of the trades we've actually increased the profit. In fact, we had a trade on Netflix that we more than tripled the profit by adjusting it twice, simply because the stock then took off and we were able to capitalize on that as well. Not all stocks take off and go crazy. We know that, and that's part of the challenge with the four up here, Vertiv, well, five up there, Vertiv, CRM, CEG, Lulu, and Meta. And I would say at this point, when we're looking at these trades, again, Vertiv, we are very close to walking away with a profit on Vertiv. If the current position were to expire worthless, we would have a profit. We're still going to see about just maybe adjusting it one more time to pick up a little more profit and then exit Vertiv for now. CRM is one that we are also reviewing, and it's up today, and we were just continuing to manage that one. We have that down to around a $10 or $12 debit, so we're going to have some work to do there as well. The Constellation Energy is another one. I think we're starting, if we can, although I think it was back up today, we'll have to manage that again as well on the call side. The Constellation Energy, I feel positive we can get fully recovered. Meta, we're also about ready to fully recover. It's really Lulu, and then it depends on what happens with CRM over their next earnings report in the next 30 days or so. Lulu, as I looked at a chart before, we did this last week. We looked at a chart of Lululemon, and it has bottomed out, and we probably will do a couple put spread trades to try to recover some of that. I just don't know if that's a long-term. I mean, long-term, that means, next 30, 60-day, 90-day stock that we want to be in. We could be wrong. The stock could go through the roof, but hasn't shown any signs of that yet. So I think what the perspective of this is really trying to give everybody a view about why we roll, why we adjust, the benefit of adjusting. Yeah, it does feel painful when we come down here and we're only getting a daily return of 0.43%. And clearly, when we add the returns from Vertiv, it'll probably be 0.1%, because we've been in Vertiv since February. Same with Meta, which we were in, it's March. So when we settle some of these other trades, the daily return is not going to look very good. And the question is, do we really, not at this point, want to take a loss on those positions so we can adjust them? So in summary, trade positions will be challenged. We obviously try to manage those positions early to avoid assignment and to defend the trade. We'd like to add more time, and we typically like to add credit where we can on a successful defense. So we track it, the net debit and the net credits, and opportunities to adjust those every time we do that. That's an important part of it too. You just can't look at your broker screen, because if you're looking at your broker screen, it only captures the latest roll or addition. It doesn't show the total profit or loss on a trade. And so that's basically what we're looking for, is exiting the best combination of time and return. So we'll continue to track these, and when we get to the end of the year, we'll do a full review of all this, because I think it's helpful. It helps me. I know I'm keeping track of these every day. We've got a list of other metrics we're looking at tracking, so we'll see adding those to addition. Remember earlier in the year, I showed our 2-time stop loss, 3-time stop loss study that we did on our actual trades, and if we had actually followed a 3-time stop loss, we would have ended up with a fair amount of losses compared to the profits. So there is value in managing and defending trades. So that's really it for this presentation today. When we get Vertiv and a couple others, I can do another sort of, okay, what did we go through with VRT? What was the value of that? And same with Meta. Although Meta, I think we're going to end up with Meta. Well, Meta, Meta's meta. I mean, it's definitely a lightning rod stock, so it's been settling down, hasn't really taken off yet as it gets going here. So, Emily, I'll take questions.
Brad says, do you have a year-to-date gain on account value? So if you had for example, $100,000 account at the beginning of the year, what would it be now?
Oh, well, the account we shifted the account when we went to the daily show. So the account that I'm trading Income Masters in was part of a called a bigger account, and I then carved it out of that bigger account into a separate account to just track Income Masters. So that and that count is up, but obviously it is not as up as high it could be because it's still carrying the Constellation Energy, CEG, Lululemon, and all that trades. But it also had other trades in there that were not related to Income Masters that were most of them were profitable, and some of them were just positions that I own. So I've carved this into a separate account. So that's so now since July. I'll come back and do a report on that since June 1st, when we went to a daily show. That's when we reorganized the accounts. And so I have a separate account for Income Masters. We're eliminating the options income account as well, and then establishing a separate MTC account, MTC VIP. So now we have that account there as well. So I can share those, but as we get a little bit further along here with the totals on that. So I also run, just so you know, I also run a third account now that's really a test account. I use that for test trading so that I don't have to mix up the portfolio of Income Masters. And those are trades that I'm testing for everything. Jeff and I both do a lot of that. Jeff Wood and I both do a lot of that to get a feel for how a stock or ETF trades before we actually put this into practice here. So I'd say 99% of the stocks we've traded ETFs, we've traded once, at least once, but usually 2 to 3 times before we trade that in Income Masters or MTC VIP.
Okay, Dave, that's the only question about today's presentation.
All right, we'll take a look at a couple positions today. The market basically flat. We did send out alert. We had a nice rise in CF Industries due to Taiwan pledge to spend 10 billion on agriculture in the US, which impacts fertilizer, which is CAF's roundhouse. So we sold the covered call on that. Take a look at that. Stocks pulled back a little bit, but it was up 6%. We sent that out before this session. And tomorrow will be our trade adjustment and new trade day for adding a couple new positions, as well as looking at positions that may need adjusted. And anything before that, we'll send out the alert. So with that, have a good day, and we'll see you tomorrow at 12:30 p.m. Live trading and trade adjustments.
All right, thanks, Dave. Thanks, everyone, for joining us. We have recorded this session. We'll post a replay to the platform. Dave said we'll see you tomorrow at 12:30 p.m. for our next live session. Between now and then, keep an eye on your inbox for alerts managing open positions. Thanks, and have a good day trading.